So 64% invested at the moment. What has it got to take in the markets for you to go back up to 80% plus?
Well, I guess some better levels, more attractive price points. So we are cautious in our outlook for 2023. I think we're going to have low growth with continued inflation. Inflation certainly peaked, but it's not going away in our opinion. And a risk of recession in the US, because we believe that the Fed is hiking rates far too quickly without pausing to see what the effects are.
So let me get this right. You're looking for a downtick in the market, i.e. a more attractive price entry point, rather than more information confirming that valuations at current levels are actually okay to dip your toe in.
Correct. We are looking for low levels.
Any ideas of what kind of level there?
Well, I mean, we've seen a massive up move in some of the stocks that we've been invested in during the kind of last 3 months. In some cases, they have gone up by 20 to 30%. So I guess I'm not looking for the whole market to correct by that amount, but we have things which we want to add at certain price points. And Ericsson, for example, the telecoms company is one of those. We have a small shareholding of that. We're also looking at Brembo Automotive in Italy. There's just a lot of opportunities out there, but we're just waiting for the right entry point, which is not at current market levels. But we're very happy with our current portfolio and its high dividend, low debt levels.
Okay, I'm going to go very specific, if I may. I noticed that AP Moller-Maersk is one of your worst performers of the last month as well. A, if you can just confirm you still own those shares, and B, what do you make of the change of leadership we've just had? I mean, it's live breaking news. I'm getting an investor's view on it.
Yes, you're right. It has been one of our worst performers over the last month. Over the year, we have had either a 2 or a 4% shareholding in Maersk, as we have had in Hapag-Lloyd. We also own Costco in Hong Kong. And I just think that in general, shipping is extremely well positioned in terms of being able to produce lots of free cash flow. These companies have low debt levels, and many of them only pay tax actually on a tonnage basis rather than on a percentage of earnings. And there's just less ships being built right now as well. So with all the goods in the world, or the majority of the goods in the world being manufactured in China, and Russia causing a lot of disruption in trade flows, which probably means more shipping, we think that's very attractive. And any change in leadership, well, I think Maersk has had a very consistent process in appointing, from a governance standpoint, effective leaders.
Richard, Mark, can I ask you about the commodities positioning? Because you've got a sizable chunk in commodities. Obviously, the speculation running into next year, as you've been discussing with Steve, is to whether we have a significant recession in the Western world and what it ultimately looks like, and what the impact would be then on commodity pricing.
Yeah, I mean, that's certainly a risk, and that's why we have reduced. Commodities was our biggest investment sector. We had 18% of a 20% sector cap invested in commodities for most of the year until the end of November. We've recently pulled that back to 10% because we think there is a risk that China's going to be quite slow in coming out of the blocks from the COVID shutdowns. And world growth is going to remain relatively low. So that's going to reduce somewhat the demand for commodities. Yet we still like the commodity producers because they are basically in a position where they have very high free cash flows. And even though some of them, like Rio and BHP, are making acquisitions which might dent the dividend prospects in 2023, or they might have to take on a little bit more debt, we still like the commodity sector in general, and we think the whole decarbonisation is obviously going to, outside of iron ore, lead to other demand for important commodities like copper.
And I read in your notes, you're very enthusiastic to talk about the outlook for the S&P 500 and specifically Apple versus Microsoft. Let me give you an open goal, shot at open goal here. Which do you prefer, Apple or Microsoft, and what do you think the S&P does?
Well, we very clearly favor Microsoft out of the two, although we're not invested in Microsoft at these levels. We have been certainly in the past. And our viewpoint is that Apple and Microsoft are the two largest companies in the US, close to being the two largest companies in the world, depending on the valuation of Aramco. And they're basically quite critical in terms of how we perform in the S&P 500 going forward. Apple in itself is 7% of weighting in the S&P 500. And we are concerned about Apple because we believe, in terms of their balance sheet, that they're running out of road. So they've now spent $550 billion on share buybacks. There's nothing wrong with share buybacks. They're very effective. But when you're borrowing money every year to do your share buyback program, Apple has just reduced its balance sheet to net equity of just $50 billion when they have a net worth of $2.3 trillion. And just the whole, financial engineering, it's been overly financially engineered. And so they're going to basically drive themselves into a balance sheet brick wall. And that's a risk, we think, for the S&P 500. And because the way the Fed have been raising rates as well, we think that endangers the outlook for the S&P 500, particularly as global debt levels have risen so sharply in the last 15 years.